Here are the 7 deadly mistakes of multifamily investing. So, investing in multifamily real estate can be one of the most lucrative ways to build long term wealth. I think it's the best. Now, the problem is, even experienced investors make critical mistakes that can erode profits, stall growth, or even sink a deal entirely. Now, today, we're going to break down the top 7 multifamily investing mistakes and, more importantly, how you can steer clear of them. John, it's great to be here with you.
So good to be here, Mark. It's been a great year so far for Faris Capital. We closed that new deal in Charleston, and we have a handful of deals that are penciling out strong. And so, just feeling, look, 2025 is going to have some challenges for many operators, and I think the economy, right? We've got a new administration, some uncertainty. But look, if you look at history, that's normal. Every time a new administration comes in, oh, there's all this uncertainty, and it just speaks to why we love multifamily because it allows us to control, right? We're not allowing the whims of the markets or the public to change our investment outcomes. We control the process, and so really exciting time. I think Ferris Capital Partners is going to have a banner year this year, so I'm pumped and excited. How about you?
Yeah, no, for sure. And we're honing in, and we got a couple deals we're actually looking at right now that are looking really good. And so there's one deal, John. I'm not going to like let it out of the bag exactly where it is, but I'll just say that when I walk through that property, I'm like, oh man, this is totally our buy box. And it has a value add component. It has three-star Google reviews. John, when I see that online, I'm just like, this is golden opportunity, low hanging fruit for us to go in, change out the property manager, implement our 28-day full out transformation plan, and really to be able to change the culture and the community and just increase overall rents. Like the properties just perform a lot better. So when I see that, which I did on this deal,
Yeah.
just super exciting. And the big trees all around, and the dirty pool that we saw.
Yeah,
It's
yeah.
like a dirty pool is like you'd be like, oh man, like why a dirty pool? But when you're looking to acquire one of these larger multifamily assets, and you see a dirty pool with a bunch of like dirt at the bottom,
Yeah.
and like we went to the washroom in the leasing center, there's no the paper towel to dry your hands, and like
Nothing.
no
Yeah.
toilet paper, and just like dirty. I don't know. Like to me, that's just low hanging fruit. It gets me really pumped up for a good potential deal.
It's the most exciting stuff that we find on these, right? Because
Yeah,
it just speaks to like, Mark, you and I, we talk about this all the time, but you and I both believe how you do one thing is how you do anything, right? And so when we were walking around that dirty pool, it was sort of like, well, it's the winter, and nobody's using the pool. Yeah, but people still look at the pool, right? And not even being able to manage to have soap and paper towels in a public restroom. I mean, that to me is just like, are you not using it? I
yeah,
mean, do I even want to shake your hand now? And so, it's just kind of that
yeah,
idea that like I'm always carrying my hand sanitizer with me when I'm
yeah.
touring property. And so yeah, it's low hanging fruit to your point, and it's really where we excel, I think, at the end of the day. I mean, amongst many things we do really well, obviously we execute on these renovations. We have our in-house construction manager. So I mean, we get the important stuff right. But man, these investments often come down to those small details, right? And we're about to get into the things that a lot of operators could miss that could really kill the deal. But for me, a lot of times it is those small details. And whether it's just a little gift card around Thanksgiving, after hurricane came through, just to make sure people had a nice Thanksgiving dinner. I mean, literally a $25 gift card, right, for every resident. We got so many thank you notes and five-star reviews just for those little gestures. So, I'm all about, whatever you do, do it well and do it right, and if you're not going to do it right, don't even do it. Right. And I think that that's my approach to life. So,
Yeah, for sure. And what happened this week as well, John, on our recent acquisition in Charleston. As you know, the fences were actually half done. So in the backyards of these assets, they had partial fence. And so what we did is we actually went in, and within 28 days, we're doing all of the renovations on the exterior. We call it, and we've done other talks on the 28-day full out transformation plan. But so that's part of the plan, is to fence in the rest of the yards and give them exclusive private access to that. And so that's going to help our overall NOI. increase. And so it was interesting because one of the residents, we installed it, and it's funny, the story that our GC ended up sharing. He was like, she came out and she was like really upset about, now you're trying to fence me in,
Yeah, yeah.
and that was interesting how what ended up happening, right? A few
Right.
hours later. You want to finish the rest of the story there, John?
Yeah, yeah, so it
Yeah.
was actually the next day, but she shows up with 10 pizza boxes and brings it to the entire renovation construction team and just said, "I had a really rough day yesterday. I'm just so sorry how I behaved." And the reason that outcome occurred is because our team, right, like, our values are ingrained in everybody, and so when we work with a contractor, we're talking about our values and, like, this is how we operate, and so, Dom, who's our construction manager, did not react to her cussing and swearing, and he didn't rise to her like tone or level of volume. He just was very calm and patient, explained why we were doing it, why we thought he thought if she just gave it some time, she might actually learn to appreciate it. But that ultimately it's something that a lot of our residents have requested, and we think you'll be happy ultimately. And I guess she pondered her behavior and decided, you know what, I need to make up for it. So it ended up being a cool story at the end of it all, and she's going to be happy. And really, it was interesting. I don't think she didn't mention this, but another resident did. What we learned is that some were concerned now all of a sudden they're going to have to mow their grass. And so, we just made sure as we distributed mailbox keys, because one of the other things we did is we put brand new, sleek, like mailboxes, just because the others had been sitting there for 20 years. They look worn out, depleted. And so it just drags down the quality of the asset, right? So we replaced those. So we're distributing the new keys, and we just made sure to let everybody know that you're not going to have to mow your grass. We'll be coming in and taking care of that still just the same. So maybe that was it. I don't know, but it just, it was a cool story at the end of the day because, he turned it around into a positive thing, right? And the construction team got free pizza, so it all worked out, right?
Well, and that just goes to show the importance of core values within the company, because Dom, he knows like a genuine love of people is really important within the company. So if he would have yelled back at her, that could have escalated, and then that what happens, that resident goes and tells everybody else that the GC was yelling at her back, and most GCs would, right? And so with Dom, he just listened with an open mind, repeated the challenge back, showed empathy, just like decent customer service skills. And you know what? She ended up coming back and totally changed her point of view. And now we have an advocate there. She
Yeah,
bought us pizzas, like
yeah,
the
yeah,
GC, the construction team, and so that was really good. From a, we'll say, customer service. But the other part of the story is that we collected that feedback, which is really good. It's like, am I going to have to cut my grass now? And
yeah.
we just didn't do nothing with it. We're like, "Oh, you know what? Probably others are thinking about that as well. Now we're going to communicate, right?" And
Mhm.
so that's where I think it's really important that the boots on the ground people, property manager or GC, that they're constantly communicating and you're gathering data and you're making judgment calls. You're taking action based on the feedback that you're getting from the boots on the ground.
That's
And
right.
to me, that just if excellence is one of the values, if that's really important, that's how that happens. You collect
Yeah,
real feedback. And actually, that was something that I was interesting. I was listening to JD Vance, recently talk about how Trump makes his decisions, and he said it's unbelievable how he collects and makes decisions. He says he speaks with not just his advisor, but he actually goes and speaks with frontline people. And then he collects all that feedback and then he makes decisions based on what the people on the front lines are saying. And so, like, for example, the people that had their houses burned down over in California, he went and actually directly spoke with the homeowners. And so that at the negotiating table, he was actually using those as references. And so the reason I'm sharing that, in any sort of business, and multifamily is no different, collecting feedback from people that are actually experiencing the service is that's what all great companies, they do that. And so they do that consistently on an ongoing basis. And this is a great example of doing that.
you might remember, Mark, when we were riding around Atlanta recently, I shared with you, I read this really interesting article about Barnes and Nobles, and Barnes and Nobles has had a complete 180. You know, going back 8, 10 years, I mean, really post Amazon, but they have kept trying to figure it out. In fact, the former CEO did some extremely goofy stuff. They literally got into the restaurant business, like no books, just restaurant business. I mean, they just tried all this crazy stuff. But the bottom line is that they were making all the decisions at the top. So what books the store would feature, you know, how their end caps would be positioned, what books would be on those end caps. And new CEO came in. He was actually a guy who turned around a big bookstore in England, and they brought him in. And within 2 years, they now are set to open, I believe, 35 more stores just this year in the United States. And all the main thing he did was he gave the decision making authority to the store managers because they're in the community. So, for example, you might walk into one Barnes and Nobles and it's all this like, you know, young adult literature because they realize, hey, that's who our customer base is. They want the young adult stuff. But like the one I go to, and I had noticed the difference. I just didn't realize what caused it. But the way things are organized are better. It's not just in alphabetical order. They might have a section for Pulitzer Prize winners, top 100 books by the New York Times, whole huge business section that they've expanded because they recognize that's what the audience or the consumers in that market want. And so it goes back to, you know, the decision making closer to the ground is usually the best. Now, in our world, what it is, we take that feedback and we have to make wise choices and filter through. And, you know, sometimes somebody might come and say, well, let's give away free rent for 2 months, but we're not doing that. But that feedback that comes in and empowering the team, right? Like our property managers know if they, for example, have a tenant that we recently had a situation where there was a kitchen repair that needed to happen. And so some drywall had to be removed. And so the woman just felt like her kitchen wasn't usable. So we gave her a $100 gift card to DoorDash just for a couple of days so she can, you know, get some food delivered. And she was just like over the moon. And nobody had to tell them to do that because they have that authority to make those decisions, to make it right for the customer. Small amount in the grand scheme of things. But you said it earlier. Now that person's an advocate. And guess what? 5-star review on Google just by that little $100 gesture, right? So, yeah, it's fun stuff. That's why I love this business. I love doing these deals because you know, you and I just have that customer focus, that resident focus, and you know, we know how to build a great team and then give them the power to make great decisions, right?
So good. So
Yeah,
good.
that's
So,
right.
John, we could keep talking business and, all day. Like, seriously, we could go back and forth because I have like 4 other examples in my head right now. I'm like, I want to share, but we are here to talk about these 7 deadly mistakes in multifamily
That's right.
investing. And so this is like when we looked at this, you're like, oh, this is going to be a fun one
Yeah,
because it is so easy to do any one of these 7. It's like you look at it, you see a deal, finally there's an opportunity, and it's like, oh, I'm gonna overlook that, or I'm gonna overlook that. And what happens is you get the deal, and then all of a sudden down the road, something comes up. You're like, oh, I shouldn't have done that. And so when you're buying a single family property, it's one thing, right? If you make a mistake, you dip in your pocket and you pay a little extra. But when you're buying a 10, 20, 30, 40 million, $50 million
yeah,
multifamily apartment, that becomes not just, "Yeah, I'm going to dip into my pocket and pull it out and fix the problem." Now you have many, many investors that are looking to you and you have mud on your face. And
that's right.
that is not a fun place to be.
Not at all. Not at all. Yeah, so I think, you know, mistake number 1, right? And this is like, you know, because it all comes down to the numbers, right? You have an unrealistic or maybe overconfident pro forma, right? And so, yeah, I'm gonna go through some numbers. You'll see those numbers on your screen if you're watching here on YouTube. These are very simple numbers. So if you're listening on Spotify, you'll still be able to follow along. But I think one of the key lessons we learned early on is that, you know, these brokers that we source deals from, are awesome. We are big on broker relationships. So I don't say this to disparage, but at the end of the day, they are salespeople, right? So they're going to present the deal in the best possible light. And so an example of that might be maybe they go out a little further in terms of rent comps than maybe, you know, a resident might consider, right? So, you know, you're in this one sub market, but oh, over here in this sub market, they're getting $300 more a month in rent. But it's like, but there's economic drivers that make those two sub markets different. And so we don't see like any like wrong information, right? But the reality is you have to be very mindful because sometimes you get that pro forma, or I should say that offering memorandum. And so let's look at some numbers. So say you get a pro forma from or offering memorandum from a broker and the property shows 100,000 in income, right? So 100,000 in income coming in on an annual basis. We use real easy numbers here. and the expenses are coming in around $40,000. So you're like, okay, that's great. Um, NOI therefore is 60, right? 100 minus 40, your NOI, your net operating income is $60,000. So let's assume there's a $20,000 annual mortgage payment. That means you're cash flowing $40,000 a year. So that's in the say the broker offering memorandum. But then about a week later, you get the financials in from the seller, and guess what? Maybe 2 or 3 months have gone by since the broker created that offering memorandum, and in that time, we've actually had some changes. Maybe some vacancies occurred, maybe expenses. So the actual numbers on this particular sample deal are now 95,000 in income, but expenses instead of 40 were 45. So our NOI is now $50,000. So your mortgage stays the same at 20. So now your cash flow went from 40,000 to 30,000, but at the end of the day, this is the critical thing to pay attention to here, listener, is if we assume a 6% cap rate, with that first broker number example, we talking about $1 million purchase price, but using the actual numbers, $833,300. So just by that little difference, 5,000 in additional expenses and 5,000 less in income, slashed hundreds of thousands of dollars, close to $200,000 off the purchase price of that property, or I really should say the value of the property. So if you ran with those brokers' numbers and submitted that offer, you might have overpaid by $170,000, right? So it's critical that you get the financials from the seller and you spend a lot of time going through those, looking for any inconsistencies, any errors, any missing data, and then work alongside the broker to get that information, right? And get that real picture. We touched on this on a previous podcast, Mark. You and I have seen financials that are basically on pen and paper, right? Or like an Excel spreadsheet, without like a whole lot of data and detail. So these are times we really have to slow down and take the time to do the math and ensure those numbers are accurate, even if that means following up with the property management team and confirming those details. So it's critical you get those numbers right, right?
You nailed it. And, if you add a zero to that $1 million purchase price, right?
Okay.
Maybe even two zeros to the,
Yeah.
to the
Yeah.
backside of that, all of a sudden it's like, ooh, that's millions of dollars off. And that is because you didn't get the real story, the
That's right.
accurate story. And it's based on, you're assuming that the broker's going to just give you everything accurate. But the bottom line is, I mean, John, you and I, we have our broker's license, right?
Yeah.
And so they're going to paint the picture the best way that it can, and maybe they could be right, right? That's a potential for something, or the expenses, you could get it there, but the reality is when you're making your assumptions, you want to be conservative, and what is the most likely and even the most conservative approach. And so,
That's right.
but first and foremost, John, it's just like getting accurate numbers, like, and that's where the due diligence and actually having somebody that's digging in, that has that deep experience, that knows the little subtle, pitfalls to watch out for. It's like,
Right.
oh, I see what's going on there. Like, that's not, the story isn't adding up here. And then to be able to dive deeper to find out what the truth is.
That's right. And so similarly, right, the same thing can occur if you're overconfident in, say, your rent growth projections or what your after renovated rents could look like. And so it's really critical to make sure that you're doing deep research and looking at, yes, things like CoStar projections would be an example. So CoStar is a data source we utilize and they look 5 years ahead and they say, okay, based on supply and, they're looking at development that's coming online or lack of development coming online. And they're making some very informed, projections. But one thing we like to do is we always pull that back about 50 basis points just to kind of say, okay, we got to be a little bit conservative here. Right now, there are some deals where maybe we only do 25 basis points just because we're very confident in the market and that we know the area and the sub market. But having a conservative approach, particularly on that first pass, and that's what we always do. We take the exit cap rate that they project in 5 years, net it up 50 basis points. We take the organic rent growth and we pull it back 50 basis points on that 5 year basis. And there's a few other factors we factor in, some of our golden rules we've touched on other podcasts. And that's where we start the review because, once again, there may be some, arguments that could be made like, okay, maybe we should actually go with their organic rent growth because we know this market so well. So it just goes back to, something we touched on other podcasts, having some frameworks in which you underwrite deals and make decisions because you can always make adjustments where it makes sense. but you don't want to go in with rose-colored glasses thinking everything's sunshine and rainbows, because, as the pandemic proved, stuff happens, stuff that we can't predict always, right? And so
Mhm.
you want to be a little bit more conservative. So, it's not only at that value you buy
Yeah,
it at, but that exit value, right? So it's just very important that you're also looking at things where you're stress testing the deal, right? So what's your break
yeah,
even occupancy? Like, what happens in a worst case scenario? So, for example, this starts to get into things like insurance, but what if, it's a 8 unit build or an eight, there's 8 buildings within the complex and one of those buildings burns? Do we have proper insurance? Do we have loss of income? And so we're going a little further down the rabbit hole here, but, stress testing your deal to say, well, what would happen? So we know, for example, on our Charleston portfolio investment, we could drop to 74% occupancy and still be in the money. And so knowing that before we buy gives us a little peace of mind that if there is a blip on the radar or something happens we didn't anticipate, we're not losing investors' money, right? You underwrite a deal and it's, 85% break even occupancy. You gotta be real. I mean, that's a deal we probably wouldn't do, candidly, just because it's too tight, right? And so that overconfidence is something that, when you're going into these, you really have to tamp down and look at it from the eyes of almost worst case scenario, frankly. What does that look like, right?
for sure. And there's some big levers, right? When it comes down to with the purchase price of what you're going in at. You might need to actually up your offer and you're looking for ways to do it. And like the exit cap rate, like that's a huge lever. You change it by a quarter of a point, that changes your purchase price immensely. I mean, your organic rent growth, that's another big lever there that you change it a little bit and it like really increases the potential purchase price that you can get in and buy it. And it still makes sense based on the performance. So it's very tempting when you're there, you see a deal, it's like, oh, and so what really helps us, John, I think, is the fact that we have some really conservative people. Both
Yeah.
you and I, we kind of have a good overarching
Yeah.
kind of mindset on this. But I mean, Madison, for example, on our team, our full time CPA, and then we have Joe on the acquisition side. Is like these guys are like, I'm not sure, and they'll
Yeah.
actually will advocate, will debate it out. And so, what I would say that really helps us is that we have different perspectives there that we debate, and so the answer that we get is something that we all agree on, and we were able to talk about both sides on why we think something and we pitch it. And so that really helps, I think, with coming up with a really conservative, we'll say, number of what it is that we're going in at, so that we'll just say we're not overconfident and that we are realistic in our performa. Because we down the road, if something goes sideways, we need to be able to look back on this and know in the bottom of our heart that we believe that was the right thing, and we thought about all different angles, because the investors will ask down the road, it's like, why didn't you think of this? Right. And so having that different perspective at the table, there's like, five of us that are negotiating and debating this out. We're able to see different sides of it. And so by the end, by the time the offer comes, it's like we feel really confident that we're seeing all perspective and that it is a realistic offer.
That's right, and we'll touch on this one shortly, but that actually speaks to one of the deadly mistakes you can make. And once again, we won't jump ahead, but that team approach, right, is super critical. So, mistake number two, and this is really for, I would say, newer investors, and I would say at Ferris Capital Partners, we would not do this regardless. But mistake number two is buying extremely distressed assets, right? So when we talk about distress, what we're talking about is probably physical occupancy issues or physical condition issues, right? So maybe the property did have a number of units that are down. In other words, they're in no shape to be rented, right? Or maybe the property's at 52% occupancy. And so the reality is those deals can look good on paper because you can get them at an incredible basis. It's a higher cap rate deal. But it's important to remember, and we touched on this in the past, but a higher cap rate is associated with higher risk. And so when you see that high cap rate, yeah, that looks like a great deal today because I've got this low, coming in price, but there's a reason it's there, right? And so, when you think about lease down, right, you're thinking, oh, this has great potential. We can come in, we can just operate it better. But, usually what's happening is the market is reason that's happening. I mean, certainly a poor performing operator could lead to some of these issues. But for example, in Metro Atlanta, there are pockets, particularly in the city of Atlanta, where there's just a high instance of fraud. So, in other words, residents that are coming in with fake pay stubs and they move in and don't pay rent. And so, those are submarkets we don't buy in. But that's what you're dealing with. So, you're going to spend a lot of time just trying to get the property level set. So, you're going to be probably leasing down more. You're going to have tenants and residents not paying rent. Those properties typically have affordability issues, and then you're going to run into debt service coverage ratio issues. So for us, I think our approach is cash flowing deals, deals that cash flow on day one, but have some of those aforementioned things, poor current operations, or older units that are not up to today's standards, and those things that we know we can do really well. But when we buy assets, they're typically already at 92, 93, 94% occupancy, right? And so they're cash flowing, and we can just come and operate the hell out of our business plan and increase that NOI. So I think that mistake that a lot of investors, especially first time investors, make is they get kind of blinded by the headline price, but there's a reason for that, right? In my opinion, and Mark, we both been brokers for 20 years, but all properties trade at market value, right? Because at the end of the day, it's what's a seller's willing to sell it for and what a buyer's willing to pay for it. And so I remember in my residential real estate days, a broker who worked for me would come and go, "I saw this incredible deal. Look at how cheap it is. I mean, you could really do it." And I'm like, "It's been on the market for 9 months. So if it was such a good deal, it would have sold." And so there's a reason why it's sitting there. So maybe don't use that as your first investment opportunity, right? So, what's your take on that, Mark?
Yeah, well, I think that at the end of the day, it needs to come down to risk and reward. And
Yeah,
so the extra amount of risk that you're taking on a really distressed property is outsized compared to the actual return that you're getting. There's
yeah,
so many things that can come up, you know, like, for example, the roof, you might have wood rot and you have rotten roofs, right? Or you might have termites in the older assets, right? Or galvanized piping, or
mhm.
you got aluminum and it's like, or there's a water break and your plumbing screwed. I mean, we've heard stories of this from other operators, right, John, where
That's right.
we had it just wrecked the deal completely.
Yeah,
And so the reality, if you're going to get like 20% annual returns, for example, you know, the if you have a whole lot more risk and maybe you're getting like 25, maybe like 30%, the potential for you to get 0% is so much greater in these more distressed assets. And so there's so much variability, and that's where we found like a real sweet spot there in this B class, 1980s and newer, where the amount of return, it actually makes sense based on the amount of risk.
that's
And
right.
so that's why, John, the assets that we're looking at, it's like 1 in 200. And
Mhm.
so, they're very, very rare, but when they come up, it's I would say, the best bang for the buck and the least amount of risk and the highest amount of upside. And that to
That's it.
me is, I'll take 20% annual returns all day long.
Absolutely. No doubt about it. I mean, you just candidly, I mean, look, if you put your money in the stock market, leave it there for 50 years, I mean, over that period of time, but it's just this kind of like, roller coaster ride that you go on. And so to get those consistent returns, you can't get them anywhere else. And it's why we love value add, and the risk reward ratio, to your point, is it's perfectly balanced, right? And it's not to say there's no risk. I mean, there is absolutely risk, because for an investor, it's really about the operator, right? And so you really have to learn a lot about the operator. So if you're talking with us or any other fund, like, spend a lot of your time doing due diligence on that operator, right? Who's operating the deal? What's the team look like? What's their track record? What's the team's resumes look like? I had a friend approach me recently, was interested in investing in a company that was building these boutique hotels, and it was super cool and everything looked great. And the first thing I noticed on the slide deck is, and this isn't a criticism, but the CEO looked like she was like 30. And then I'm looking at all the like executive leadership team, and they all look like they're in their 20s. And so I said, these people may be brilliant, but I would find out, are these like experienced hospitality leaders, or are these their friends? And after having the conversation, he's like, it seems like it was a bunch of their pals, like, let's build a business, right? And it's like, okay, operating a hotel, if we were to get into the hotel business, we'd go find somebody who's operated hotels for 20 years and bring them on the team, right? We're not going to just hire a friend and go figure that out, right? And so it's really critical that you vet the operator. In my opinion, with these deals, The risk is obviously, the submarket and the deal itself, right? There, you have to do your numbers there. But if you like that, then the risk for the investor really just boils down to who's the operator, right? And so that's for us. We're always willing to get on the phone and talk through these questions that you have, answer any questions, and make sure you're comfortable with us before making that important decision to invest.
Yeah, you nailed it. All right. So, mistake number three: underestimating the amount of capital that you need in order to to not only close on the deal, but then to run that deal. And so, this is something. There's a lot of things that can come up. I mean, anytime you build a property, for example, every most builders know that in general, or if you're building for the first time, there's always more, right? You get less, we'll say, draws than you expect. It takes longer. You need to fund more. But with all sort of acquisitions, even when you're experienced, you got to make sure that you have proper reserves. And that's where when you have an experienced operator that you're working with, there's less, we'll say, surprises that come up. But the reality is that sometimes the lender actually forces you to have reserves, and the money that you thought that you were going to get, they're actually holding it as a reserve to be able to pay, maybe it's for insurance or taxes, or it maybe didn't factor that in,
Yeah.
right? So this is a big one that comes up, that, when it comes down to running these deals, it's like running a business. And if you run out of cash, it's like running out of oxygen. So
Mhm.
you need oxygen to live, just like a business and a multifamily investment needs cash to be able to continue to operate,
That's
right?
right.
And so this is a big one there that's very easy to do unless you have somebody like extremely experienced to be able to think about all the different scenarios that can come up in order to be prepared for it.
That's right. And it's why we have a construction manager full time. So when we tour a deal that we're considering buying, he actually flies in as well. So we can not only leverage, Georgia Patron, our senior VP of acquisitions knowledge, and she knows this stuff like the back of her hand, but we bring in that construction manager because he just looks at things a little bit differently. And so to your point, you buy a deal and then come to find out the roof needs to be replaced. That deal may no longer perform just based on that miss alone. And so we've done topics on our due diligence process and like how you should be approaching due diligence as an investor. So very robust. We'll just leave it there. But making sure you have a strong, kind of contingency budget, right? So we take whatever our contingency budget, net it up 10%, just because we know pricing can fluctuate and we know sometimes materials costs can rise. So having that contingency is also so critical. But not to spend too much time here, so we don't want to redo the due diligence podcast, but spend a lot of time, invest in the money to have contractors come out and look at these things, camera the plumbing lines, inspect the electrical systems, inspect the roofs, because a miss like that on a multifamily deal of this size could 100% kill the deal. Now, in fact, we bought an asset from an operator, and it wasn't this deal, but the reason they shut their doors and liquidated all their assets is they made that mistake. They bought a deal. It was built in the 70s, and within their first 6 months of ownership, the entire electrical system failed, and it cost $1.2 million to repair. And that deal no longer had returns left. I mean, it just killed the entire deal. And so they literally closed up shop and liquidated everything. And so we picked up a deal in that portfolio, not that one, as I mentioned, but there's a great example, and it's why we don't buy 70s, for that very reason, because of just faulty and just material that, regulations changed in the 80s. But you can do that same thing on a 2000 asset, because guess what? If it was built in 1998, we're sitting here in 2005 and that roof hasn't been replaced. That roof's going to need to be replaced, right? So that might be a deal we don't even look at for that reason alone, because that roof replacement does not add value. It has to be done, but it's not adding NOI, right? It's actually a drag on NOI. So very critical. You do not underestimate your CapEx budget. So don't just, guess. Bring a contractor out, get real quotes, and maybe even get two or three, especially if you're going it alone, right? Especially if you're just considering a residential property. Spend that same amount of due diligence, whether it's one deal or a 150 unit deal, right?
You nailed it. Yeah, you nailed it. And so, just one last thought on that. I mean, there's many different things that can come up. And so, for example, one of the deals that I had invested into, the operator ended up getting insurance for the building, but there was we'll call it a rider there. There's an asterisk basically saying for any sort of named storm, the insurance is the it was like a $2 million deductible. And so there's insurance, but if it's a named storm, you have a $2 million deductible. And
Yeah.
so, storm comes in and it ends up blowing, the roof needs to be done. And
Yeah.
so it's like $750,000 roof. Well, the reality is the roof needs to be done. You don't have the capital and the reserves to do that. What do you do? So that's where you got to come up with the capital to get that done. Like it's a
Yeah.
must. So now you're going back to the investors and all the rest of it. So,
Yeah, I was
you know,
about to say what that looks like is a phone call to every investor saying capital call. And,
yeah,
as an operator, that's not a great place to be in, but as an investor, that's about the worst thing that could happen, right? So, yeah, it's critical you get these details correct. That's right.
you nailed it. Yeah. So we're talking about now mistake number 4. So chasing high cap rate deals. So this is something that high cap rates, we get the questions a lot. It's like, what's the cap rate? What's the cap rate? So cap rates are important to be able to, it's a snapshot in time of how the deal is performing. So the key here that is really important is that it might be a lower cap rate, but the lift in the upside is really strong. As in, like, they might have $400 per unit lift in the deal. So just because it's a high cap rate doesn't necessarily mean that it's a stronger deal than another deal that's actually a lower cap rate. Like the business plan for the lower cap rate deal could be much stronger there as well. So if you're only focusing on high cap rates, you could be missing out on a whole lot of deals when it comes down to it. And so the cap rate is also an indicator of the amount of risk. As John,
Yeah,
I know we were talking a little, about this a little earlier,
that's
is
right.
that those are riskier deals as well in general. And so
That's
that
right.
you just got to watch out for that.
Yeah, so just general rule of thumb, your higher cap rate deals are going to typically be in less desirable areas. And this may sound off when I say it, but I'm going to say it. Generally, the quality of the neighborhood informs the quality of the residents, right? So, lower quality area, you're probably going to see more issues with, getting residents qualified, right? Whether there's evictions on their record or things like that. Now, we have a genuine love of people as one of our core values at Faris Capital Partners. So, for example, if we see an eviction during the pandemic era, but everything has been on track since then and they have great credit, it's like we're going to make a little bit of an exception there. And that's a judgment call that we make alongside the property management team. So we don't just reject people out of hand. We try to have a conversation and employ that genuine love of people, but we are operating a business. So we have to make very intelligent decisions. So that quality of the area, once again, informs the quality of the residents. And I said this earlier, but it's just the reality. Deals trade at market value, right? And so that lower quality building, it's not like we can take it and move it down the street into a nicer area. It is where it is. And so just for us, I'm not a gambling man. I mean, Mark, it's funny, you and I've had a few trips to Las Vegas for a business conference, and I think we're both in our room by like 8:15 after dinner. But it's like I do not like to gamble. I
Yeah,
just and so
yeah.
this is not what that is. Like, we're making very informed, intelligent decision based on and Mark, I mean, I would estimate we probably spend 30 to 40 hours as a team reviewing a deal before we get to LOI, and that
Oh,
might even be
easy.
underestimating it,
Oh, no, easy, easy, easy.
and I mean,
Yeah.
that includes, yeah, the comp tours, the underwriting process. I mean, we'll meet on one deal sometimes 6 and 7 times, as a team and reviewing the underwriting, making adjustments. And, George and I are meeting with the property management teams and creating strategies. And so there's this whole process that goes into it. And so it just goes back to if I'm going to, well, let's put it this way. I'm going to take your money and put it in a deal, but I'm going to put my own money into a deal. Like, it's got to be almost a guarantee. And so for us, that's high quality areas with high demand drivers, employment growth, population growth, and employment diversity, which is something we talk a lot about, which basically means a lot of different employment segments. So not just one employer employing, the majority of employers. So for example, the deal we're looking at now, it's like 25-30% are in professional management. There's about 10% in real estate and finance. There's 4% in construction. I can keep on going, but it's just very diverse tenant base and a very diverse economic base in that submarket. So if one industry has a downturn, we're not losing all of our residents. So that's for us why we like, you might say, well, gosh, I'd love to buy this deal at a 6% cap rate, but if it supports a 5.5 and it's a good deal and it pencils out and in 5 years we can get those returns, I'm doing that all day over a 6.5 in a less desirable area. that just associates more risk with the deal, right? Because, you and I put our own money in these deals alongside the investors. So, it's a, catalytic mechanism to make sure we deliver those returns because we're going to feel that pain as well if we make a mistake and miss, right?
Okay, great. So before we get into mistake number 5, I want to share that we are getting very close right now to getting our next acquisition. You definitely want to get on our short list. So make a reservation to be able to be informed first, because we do have limited spots that are available for high net worth investors to be able to get into our next investment opportunity. And when those spots are gone, they're gone until we find the next one, which could be months and months, because these are very extreme, rare deals, 1 in 200, but we are getting close to our next acquisition. Make sure you get on our reservation list. And by doing that, you'll be first to be informed about it. So go to ferriscapitalpartners.com to find out more and to get on our reservation list.
That's
All right,
right.
John. So mistake number 5 is going it alone. So
Yes.
doing things on your own at the end of the day, I would just say, especially in the larger multifamily stuff, like, it takes a village to take a property like that down. And, when I started digging into it, initially it was just, Madison or CPA and myself. And then it was like, we partnered up, John. And then all of a sudden we realized, like, oh my goodness, okay, we know what our strengths are, but we need this, and we need this. And so we went and recruited and we brought everyone in. And so now the amount of communication, coordination, and we'll say experience needed in order to do it well is, I would just say, I mean, in most business, all businesses, you need experience, right? But in the multifamily space, because when the deal comes up, it comes up quick, and you can't just, take all this extra time, weeks and months. You've got to move quick on these deals because there's like 50 other groups that are ready to buy. And so by going it alone and doing it on your own, there's a high risk of not only missing out on the deal, but getting something wrong on this can cost you a lot of money.
That's absolutely right. Yeah, for us, when we hire, we actually look for diversity of opinion, right?
Yeah.
Diversity of kind of like approach, right? You mentioned Madison earlier, and she is like a delight. I love Madison, but she does tend to have a little bit more of a skeptical outlook on things. She's an accountant, CPA, so she
Yeah.
gets into the details, into the numbers. I tend to really focus a lot of my time on the submarket itself and on those economic dynamics and those drivers. And that's kind of like, if I had a specialty around that. And then you've got Joe on the acquisition side, with the structuring of the deal and the debt and, obviously the assumptions and the projections. And then you bring in Georgie, who has that expertise on actually operating these deals as an asset manager, right? And so you come in and it's like the five of us, almost effectively all have to agree before we're going to move forward with that deal. And so if we can't come to that meeting of the minds, and so guess what? We are still a newer company, but we haven't had a miss yet because of that. And I would say you also need to take it a step further. And this is actually for that individual maybe who's just flipping a home or buying a short-term rental or a long-term rental. Build a power team, right?
Yeah.
And I use this as an example because, like I've got a buddy who's an attorney and he's kind of an employment attorney, but he covers some other things. So at the gym, I might ask him a question or two. And I try not to be that guy getting free advice. And I've actually used his services for certain things, paid. But it would be like going to him and asking him to structure a purchase and sale agreement for a real estate closing, right? He could do it, but I'm going to go out and find the best real estate attorney in the market, right? And so for us, that's Kelly Clark. We work with them. It's all they do. All they do is work on these exact types of deals. So it's like they have that expertise. So when we have an approach we want to test, or we're thinking about compliance issues, it's like we have the best in the business, right? And it's all they do. Property management, not just choosing the property manager that's closest to you, going out and vetting 3 or 4 property managers, getting a deal maker lender, right? Not all lenders are created equal, right? Some are willing to get creative and they have bigger Rolodexes and they can reach out. So building that power team is something we also focused alongside our internal team, right? And so folks like William Lawson that we work with on the debt broker side, I mean, we have a great team of people. And guess what? We vet those people for the same values we have, right? So that they operate the same way. Responsive, kind, aggressive, right? And some of those things that we want to see in our vendors too. So, taking that time to build that power team and not just relying on yourself or, God forbid, going online and trying to download and I've seen investors do that, download a purchase and sale agreement for free and use that, right? You need a team. And I think that's a critical component. Do not go it alone.
Yeah, for sure. And you want to do this before you find the deal, because when the
Yeah,
deal comes, you can't be wasting time trying to find somebody, right? So you
that's
want to
right.
build it first. And so a really good example is a an attorney. So you might think they're all the same, but for example, the attorney that we use, I mean, during a time that there's a lot of operators struggling, he'll actually go to the lender and negotiate if they're in trouble. Like he's doing that.
Yeah,
And so a good lawyer can get you out of a lot,
that's it.
right? And so you got to find those rock stars that when you need them, they're there. And so
Yes.
that power team, the relationships, they won't go to town if they don't know you. So you got
Yeah.
to build a relationship. So what I would say is you definitely don't want to just go with the cheapest person. You want to go with the person that, not only has the we'll say the most experience, but they're the most creative in how they get things done. So they're a top producer and they're probably more expensive as well. But I'll tell you, when they peel you out of a situation, you realize that they were worth every penny and more. And so that's a really good example there of building a strong power team that will help you in not only at the beginning, but will help you throughout a whole period when you really need them.
That's right, and I think it was Peter Drucker, if I'm not mistaken, but the management, guru, that single sourcing vendor kind of approach where at Marks Payne Real Estate, the company I co-founded, for example, we try to do as much business with in Atlanta, I'll say Weissman Law, and number 1, they were the best, and Seth Weissman was also the, general counsel for the Georgia Association of Realtors, but we knew if we drove hundreds of closings to them on a monthly basis, which we did, if something came up at Friday at 5 PM and the lender's saying it's gonna take an hour to get the documents over, guess what? They're gonna stay and get that closing done at 8 PM if that's what it takes. But if it's just the first closing I've ever had with that attorney, we're closing Monday and maybe we're losing the deal over it, right? And so, I hate to say we have power, but when you do a lot of business with vendors like that, it's mutual, right? We both step up to help each other when we're having those challenges. And I think that example you gave where the attorney's like on the phone with the lender helping negotiate a workout for some of these operators they do business with just speaks to that, right? If it was the first deal you ever did with them or you just used the cheapest guy or gal, you're going to get probably what you pay for, right? So, critical to have a strong power team there.
No, and it's a real thing that when you have a great relationship, they will go the extra mile for you where they won't do it for others. And you may say that's not fair, but that's just reality. And so that that power team there, it's of untold importance. Not only like internally, but if you're your own investor, make sure you build them strong, and look after them. And this is not the time to be looking for discounts, right? It's like what kind of deal will you give me? It's like when they see that, they're like, "Oh, you're trying to take from me. You don't see my worth." And they're not going to go the extra mile. You might save in the short term, but in the long term, you're actually losing out. You want to make sure that you have somebody there that you can count on, you build relationships with, and ultimately you're going to be able to the net in your pocket at the end of the day will be a whole lot more.
That's right. And then, look, after a year or two of building a strong relationship, you do a lot of business. You might go back and say, hey, look, we're doing X amount of business and we do this, and come together with a mutual program, right? But yeah, I'm totally aligned there. So number 6, Mark, is just poor debt structuring and financing terms. And so, in this space, there's a lot of options. You got Fannie, you got Freddie, you've got, floating loans. You can do fixed rate. You can do 5-year, 3-year, 10-year. There's different amortization schedules. And then there's different leverage amounts. And so what sometimes happens is an operator comes in and tries to get the most amount of leverage possible, but they don't calculate what that looks like if something were to go wrong, right? In other words, now we've got this debt service coverage ratio that we've got to cover. And so our break even occupancy is now a much higher number. Maybe it's 85, 87%. And so if that's what it takes to make the deal work on the front end, then maybe it's not the right deal. Now, we're all about leverage, right? I mean, at the end of the day, it's why we love investing in real estate because, you can leverage the bank's money to help juice your own returns. but not just going for what you think are the best terms. It's like, what are the best terms for the deal itself, and what is the deal support? So, for us, we've talked on this on previous podcasts. We do not do adjustable rate unless we have a cap rate that is solid. But on every deal we've done so far, it's been fixed rate financing. Like, it's just to say we may do floating rate, but it would have to be with a cap rate where we know and we can predict exactly what our exposure would be if interest rates were to increase, right? And so just your better approach is to secure longer term, like fixed rate financing and stress test the hell out of the deal. And if it means you got to raise a little bit more capital, that's what you need to do. But that's your best approach. Don't just go for the highest amount of leverage or, who offers you the lowest origination fee or whatever. Make sure it's the right structure for the right deal.
Yeah, for sure. And like, yeah, you nailed that. Like in regards to interest rates, I mean, that's one thing, but what are the terms of the deal?
Yeah.
So, like, if you need to break the mortgage, what does that actually look like? What's your prepayment
Yeah.
penalty? And so, this is something that really looking at the overall um, scope of that. And then, can you get an extension there? So going out a 5 year, what happens if if interest rates were to go up and double? By then, did your NOI increase where you can actually cover it? Or like uh, a rate cap standpoint as well, when you're going in and buying these deals, if it's only a 3 year, it's at the end of the day, what will happen if interest rates go up in 3 years? Are you driving enough value add that down the road you're going to be able to get financing at that where you're not having to raise extra capital just to get another rate cap at the end of the day. So thinking all these through is really important, and that's why, John, with us, we like fixed debt just because it's consistent, and no matter what happens in the market, we know what our payments are. And so if the deal works at that number,
Yeah.
then, we're able to just kind of sleep better at night. And we got 5 years to work our business plan, which is even going to drive up NOI even more. And if
Yeah.
we're getting a 20% return on our performa, like we'll take that all day long and not
Yeah.
take that extra risk on.
Well, and you said this earlier, right? That prepayment thing, they call it yield maintenance in the business, right? So, if you say, for example, take a loan with lower interest rate, but it has yield maintenance through years 5 or 7, yield maintenance is kind of hard to predict because it has to do with treasuries. And so, if anybody could guess what the treasuries are in 5 years, like they'd probably be worth a couple $1 billion, right? Because it's just impossible to predict. Let's just put it that way. And so not knowing, you don't actually know what your exit valuation is going to be, because if you can't calculate what that yield maintenance payment is going to look like to the lender, then it's a guess. And so, you can make intelligent guesses, but once again, these things are out of our control. So in certain cases, it might be better to take a slightly higher interest rate, but know in year 4 or 5, you just have a 1% prepayment penalty, because now we know what that math looks like. We can work it into the deal. And so the deal may work better even with a slightly higher interest rate, but better terms attached to the loan, right? And so that's where it comes back to. It's not always about the lowest rate. It's not always about, the most leverage. It's about what is the deal support. And then in our world, how can we calculate what that exit's going to look like with real numbers, not, well, we hope treasuries don't go down or up too much and,
Yeah.
kind of make the yield maintenance more challenging, right?
Yeah. We hope that's not something you want to be
Yeah.
saying in
Hope
the
it's not a
larger
good business
multifamily.
strategy, right?
Please, please, no, that's probably not something you wanna do. All right, so mistake number 7 is ignoring local market dynamics.
Yeah.
So, this is something, John, that I realized that it's more polarizing, where I'd say stark contrast from one neighborhood to the next, more so in the USA compared to Canada is what I've noticed. And so you could go one neighborhood over and it's completely a different market. You might look at that and look in the general area and say, "Oh, that looks like it's pretty good value." But all the locals know that one street over is where the neighborhood changes, right? And so that local market insight is of untold importance, because if you're projecting to get, say, 1,700 in after renovated rents per month, like, and you're doing your comps and you're taking from outside areas that are getting, that all day long. You if you don't know that local market dynamic, when you go and start advertising, you're going to realize, like, I can't get that rent, and then all of a sudden your numbers aren't being hit. And so that's so critical that you understand at a deep level that local market knowledge in order to get your numbers right and to be able to perform.
That's right. I mean, there's literally neighborhoods in Atlanta where you can be standing in a $2 million like front yard, $2 million house, throw a football and hit a $400,000 house, And so it is. And there was actually a deal we were looking at recently in Metro Atlanta. It was sort of in the northern suburbs. And I'm in Atlanta, so I knew the market pretty well. I was already a little questioning it because I knew this pocket. It's not like it's unsafe. It's just a little bit of industrial area. And, when we got over and drove it, it's like the nicest little pocket of that industrial area. So for a quick minute, I'm like, oh, maybe this could work. But then I'm like, let me just drive around a little bit. And sure enough, you drive a block or two over and it's distribution hubs and a lot of traffic. And you go 5 minutes down the road and you're in a much better place with better amenities, lifestyle amenities, restaurants and shops. And so residents have that choice. And then we're looking at the market down and we're saying, well, the top rent in this market is $1,500, 5 minutes away at 1750. And, without naming names, the broker was pulling rent comps from those other areas. And so that's not necessarily deceitful. They have rent comps in that area too, but it is super critical you understand the market you're investing in. And that's why before we invest in any deal, the entire team, let's back up, not the marketing team and, some of our sales team, but you, me, our asset manager, our acquisition director, and our construction manager at minimum come and tour the asset. And we look at those rent comps together. And then beyond the rent comps, because, when you're touring rent comps, you're generally driving the area, but we just circle around. We pull into the different shopping centers, the different amenities. We try to eat in the local area and just, what does it feel like to live here? What is this, what is this area really like? And what's the vibe? And it's super important. So submarkets, a 5 minute drive can make it's like you're in a whole different world, right? And so super critical to get dialed into that.
Yeah, amazing. Yeah, this is really powerful talk here. If you focus on those seven, and just to recap what the seven are. So number one, the seven deadly mistakes in multifamily investing. Number one is being overconfident or unrealistic performa. Number two, buying an extremely distressed asset and perhaps maybe not having experience with that, because if you know what you're doing and you've done many of them before, go ahead, but that's definitely a deadly mistake, what to watch out for buying an extremely distressed asset. Number three is underestimating the amount of cash that you need on capital expenditures and just running the deal. The next one is chasing higher cap rate deals only. And next is doing it alone. If you're just going in and you don't have that power team and a team to be able to help you through when the deal comes up. And then next is poor debt structuring and financing terms. You got to really make sure you get that right. And last deadly mistake in multifamily investing is ignoring the local market dynamic. So if you really focus and you get those right, you're going to be well ahead of most operators that are out there to be able to have a well performing multifamily investment. Anything to add here, John, before we wrap up?
No, Mark, that was a great talk. It was a lot of fun. And no, nothing on my end.
Good man. Okay, guys. So just remember, go to faircapitalpartners.com if you want to get in and find out what our next deal actually looks like, because we are honing in and we're getting close. Go to faircapitalpartners.com and get on our reservation list to ensure that you are notified first and that you don't miss out on our next investment opportunity. Thanks for listening, guys. If you enjoyed the show, go ahead and subscribe and share it with other high net worth investors that you think will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.